Welcome to Module 3 and Chapter 7 and Video Lecture T7A on capitalizing an expenditure versus deducting. Let's start with the Module 3 learning objectives. We need to differentiate between expenditures we deduct versus those we capitalize. And we start with that in this video. We will talk about the disconnect between capitalization, cost recovery, and cash flows. We're going to examine the different forms of cost recovery used in tax. We'll examine the results of a sale, exchange, or disposition and how that converts into a gain or loss. And lastly, we'll talk about determining the character of that gain or loss.
Enough is enough! I have had it with the
costs that I need to expense or deduct.
Everybody strap in! About
Capitalize some costs. Okay, let's get going on the capitalize versus deduct question. It starts with the matching concept. Expenses should be matched with the revenues they generate. If that is so, then how to deal with an expenditure that will provide a long-lasting benefit? Of course, we should think of just such a thing as an asset. This is a cost that we expect to provide future benefit. In tax terms, think of it as an expenditure that provides a benefit that lasts substantially beyond the end of the year. Rather than expense or deduct that cost, we instead put it on the balance sheet. That is capitalization. Then we ultimately recover that cost in a variety of ways. Two common ones being when we sell that asset, or maybe just ratably over time, which we often call depreciation or amortization. As the asset is used to produce benefit, it also generally wears out, and so this ratable cost recovery makes economic sense.
enough is enough! I have had it with the
Costs that I need to expense or deduct.
Everybody strap in! About
Capitalize some costs. Here's a journal entry representation of capitalize versus deduct. The first entry shows how an expense is recorded and disappears into the income statement. The second entry creates the asset that will land on the balance sheet and be carried until the cost is finally recovered. Note how that the cash and the expense are simultaneous. Well, sometimes it goes to accounts payable first, whereas the cash is often long gone before the asset is recovered. The types of things we generally think about capitalizing are property, plant, and equipment, prepaid assets, inventory, and intangibles. These all generally start on the balance sheet, that is, we capitalize them, and then find their way to the income statement through a variety of means. With this in mind, let's read about Daniel in Toshland. If we analyze the after-tax cost of the property, if we're able to deduct the cost immediately, it's quite straightforward. The deduction generates $30 of tax savings at the 30% tax rate. If, on the other hand, Daniel elects the ratable recovery over time, the present value of the tax savings is something less than $30 due to the time value of money. Hey, wait a second. We learned that back in the timing variable lecture. Generally speaking, accelerate deductions. The tax rules on capitalize versus deduct are a bit vague. First, Section 162, which you don't need to learn code section numbers, allows the deduction of all ordinary and necessary business expenses. We've already covered that in the last module. Section 162 also seems to give us permission to deduct everything.
enough is enough! I have had it with the
Costs that I need to expense or deduct.
Everybody strap in! About
Capitalize some costs. However, Code Section 263 comes along and puts a stop to that. For years, this is what taxpayers had to go with to make the capitalize versus deduct decision. Regulations were issued by the IRS, and then reissued, and then reissued. And then finally, in about 2013, a reasonable set of regulations were issued that provided some meaningful guidance on this topic. Those regs are beyond the scope of this course because, frankly, they'd be an entire module to themselves. Expenditures that substantially increase the value, increase the useful life, or adapt property to a new or different use must be capitalized, whereas routine maintenance and repairs can be deducted. There are a few rules in the regulations that are definitely worth noting. A taxpayer can deduct all expenses up to $5,000 if, number one, they also deduct the same costs for their books, and two, the taxpayer has audited public financial statements. But there's no reason to cry for privately held companies. They can do the same thing, but up to $2,500. The taxpayer must have a policy in place at the start of the year. A second regulation worth noting is that maintenance is considered routine and may be deducted if the maintenance would be expected to be performed 2 times or more during the asset's useful life. If that's a building, then more than once in 10 years. Lastly, certain small building improvements can also be deducted. There are a number of deduction provisions built into the tax code as a matter of policy. For example, the deduction of cost to make a building handicap accessible. As incentive to increase research spending, those costs are also deductible. The capitalize versus deduct decision used to be fairly important. We saw from Daniel and Toshland that taxpayers generally would prefer to deduct, and conveniently, at least for the next decade or so, they will be able to. Most business property can now be deducted immediately. We will discuss how this works in much greater detail in a couple videos. Okay, that brings us to the end of video T7A. The next video is an overview of basis. Thanks for watching.